Good afternoon, ladies and gentlemen, and thank you for joining our session. What does the last half of 2025 look like for the S&P 500 and gold by Mr. Avi Gilburt? Mr. Gilbert is an Elliott Wave market analyst and author of ElliottWaveTrader.net, a live trading room featuring analysis by a dynamic community of professional traders. Mr. Gilbert's Elliott Wave analysis appears frequently on sites such as TheStreet.com, MarketWatch, Forbes, and Seeking Alpha. Mr. Gilbert, the floor is yours.
Thank you very much, and thank you everyone for joining me this afternoon. I apologize up front. I'm recovering a bit from a concussion that I got on Sunday playing ball, so I'm moving a little bit slower, and I'm going to be keeping the presentation a little bit shorter than normal, but I will open the session to questions when I'm done. So I'm going to ask if you can please wait until I am done with my presentation before you post your question. And if you post your questions, please post it in a full English sentence and reference the specific chart or time frame that you're questioning. And let's try to keep it on topic. I know that I was going to present only on the S&P and on gold, but I may include an oil chart as well because of what I'm seeing in the oil market, which is quite interesting right now. So for now, I'm going to get into it. And for those that don't know me, and you heard that I'm an Elliottician, let me basically explain what that means. Ralph Nelson Elliott, back in the 1930s, discovered that the market consists of a fractal. And that fractal pattern is driven by mass sentiment, which is really biologically driven, and it's more endogenous to the society as a whole, more psychologically driven, rather than as exogenous factors push and pull the market, as most people believe. Many studies have been done over the last 30, 40 years, which show that even though people believe that the market is driven by news, when you actually look at the studies, you will see that the news supposedly drives the market less than a third of the time. So then, if that's really the case, can we really say that the market is driven by news? It really isn't. The market is more endogenously driven by market sentiment of the public en masse. And what Elliott discovered was that sentiment was patterned. And that pattern takes shape as a fractal. And I'm showing you an example of the fractal. What is a fractal? It means the market is variably self-similar at all different degrees of trend. What does that mean? Well, if you look at the chart I have in front of me right now, and we're just going to go through the basics of Elliott Wave so you can have a general understanding of how I'm coming about the charts and about to show you. It basically means Elliott identified the market moves in 5 waves. Waves 1, 3, and 5 move with the trend, and waves 2 and 4 are counter trend. Furthermore, when I said that the market is variably self-similar at all different degrees of trend, waves 1, 3, and 5 can be broken down into 5 waves themselves. So if you look at Roman numeral 3, you'll see what Roman numeral 3 is broken down. I labeled it for being broken down in 5 waves. Roman numeral 1 is the same, and Roman numeral 5 is the same. In fact, if you go into wave 1 of wave 3, you would also, if we go deeper and we go into a lower time frame, you would see wave 1 is broken down into a 5-wave structure, and wave 3 of 3 is broken down into a 5-wave structure, and so is wave 5 of 3. Same thing with wave 1 of 5, wave 3 of 5, and so on and so forth. So no matter what time frame you're looking at, the market is basically running by a fractal, which is driven by mass sentiment, and not so much as the news as many people believe. So I'm going to close this. Now that we have a general understanding of where we are, what we're trying to look for, and I'm going to show you our 100+ year chart on the S&P 500. So remember I said that waves 1, 3, and 5 move with the trend, and wave 2 and 4 move counter trend. Well, on our very long-term chart, our major wave 1 topped here right before the 1929 market crash. And if you remember, the 1929 market crash took the market down by something like 80 some odd percent. 85%. It was a very large percentage of the market basically crashed within 3 years and happened very quickly from a relative standpoint. So we had our wave one that topped in 1929, and you have your wave two that bottomed in 1932, I believe. Now, from wave two, we're going to track, and I'm talking about wave one, Roman numeral wave one in paren, and Roman numeral wave two in paren. And if you follow this up, now remember I said wave three should be broken down into 5 waves as well. And that is exactly what we're showing here. And we're even showing further breakdowns within wave 3 of wave 3. But I think that's going to get a little too complex, so I'm not going to go to that level. What I want you to focus on is we have the larger degree wave 1 here, the larger degree wave 2 here, and this is your larger degree wave 3. Yes, that means that I am foreseeing the market as coming to a conclusion in a almost 100-year bull market. Now, what is really interesting about that is because back in 1941, Ralph Nelson Elliott himself made a prognostication that the market was about to enter. In 1941, he said the market was about to enter into a 70-plus year bull market. And that is exactly what we've got. And in my opinion, that probably is the most prescient market call, best market call by far of all time. But unfortunately, in standing on the shoulders of giants, we now have to recognize that that very large third wave rally that began right after, during the time of the Great Depression, basically is now coming to an end. And how do I know that? Well, let's remember we said that wave 3 itself will be broken down into 5 wave structures. Well, wave 1 was here, wave 2 is here, and all of this big move higher was a massive wave 3. After wave 3, we got our counter trend in wave 4. What was that wave 4 counter trend? Well, wave 3 topped in 2001 by the dot-com bubble, 2000 dot-com bubble. And then we dropped to 2003. We had a counter rally up to 2007. And then we had our market crash in 2008 into 2009. That is a 4th wave. So we topped in that wave 3 of this wave 3 here. And we got a 4th wave counter trend, more like a sideways correction. We call this a flat in Elliott wave parlance. And that was our wave 4. And since our wave 4 in 2009 completed, we have been finishing off this wave 5. Now, interestingly, the COVID crash potentially was our 4th wave, but there's question as to where the 4th wave is here, but ultimately, I think we're all pretty much in agreement as to the fact that we are now completing the 5th wave of the 5th wave of this long-term 3rd wave. Now, because I'm an Elliottician, my job requires me only to count to 5. But since we're finishing off wave 3, I know what comes after wave 3, and that's a large degree wave 4. And that is my next expectation in the bigger picture. Now, I want to explain that while the wave 2 of this large degree rally was basically a crash that took 3 years, Elliott provided us with what he called the theory of alternation, that if wave 2 takes shape in a certain way, wave 4 will not likely be taking shape in the same way. So I'm not expecting a major crash for our wave 4. Rather, I'm expecting a very long, drawn-out process that could take us as long as 13 to 21 years for this wave 4. And we will see a lot of mini crashes during that period of time. Not in a 60, 70, 80%. You're not going to see those type of crashes most likely, but we're going to see a lot of mini crashes along the way. So now that I've shown you this, I'm going to go into, remember I said the 2000 and 2001 to the 2009 timeframe was this wave 4 flat. And now we're completing this larger degree structure here. Well, that's what I am looking at now as completing this larger degree wave 3. So the question is, are we almost there? Have we already topped? Well, before I go into more specifics of where I think we are at this moment, I want to show you how I think the path will take us going forward. Now, fourth waves, we said were counter trend. And instead of taking shape as 5-wave structures, second wave and fourth wave counter trend structures take shape as 3-wave structures. And we count those as A, B, C. And for the larger degree, that first A, B, C is just the larger degree A wave. Then you get a bigger B wave rally like we got here back in 2000. And if you could see, A wave, B wave, C wave. And just so you know, C waves are often considered like crash-like waves. 2008 was a crash. That was our C wave. The COVID crash was a C wave. If you remember the flash crash back in, I think, 2010, 2011, that was a C wave. C waves are usually known as our crash waves. So we're going to see, in my opinion, we're going to see several of those. We're going to see a C wave in this A wave. It'll be a mini crash, hundreds of points. We're going to see a larger degree C wave here to finish off a larger degree A wave, thousands of points. And then we're going to see an even bigger C wave to finish off the fourth wave. Again, even greater thousands of points. Now, if you look at the larger degree chart, you may see something that is very disturbing. And what I find very disturbing is that the target for my larger degree fourth wave is in the 1000 region. I'm not going to go into the manner in which I've calculated that. That gets into some technicals, a technical discussion of Elliott wave. But let me give you a quick story to explain how accurate these can be. Back in 2011, when gold was going through a parabolic rally, I put out one of my first public market calls, and I called for gold to top at 1916. Remember at the time during the summer of 2011, it was already in a parabolic rally, and I'm writing that I expect to top at 1916 during this parabolic rally. And of course, most people did not take me seriously at that time. It was my first article of a prognostication. Nobody really took me seriously. Most people thought I knew nothing about the market. So I got a lot of snide comments in the comment section. But one person almost humored me and asked me, well, if you think gold's going to top at 1916, where do you think it will go once it tops? And I said to him, well, the general parameters suggest we could get back down to the 1000 region. And at that point, he no longer took me seriously and also chided me for my views. But needless to say, gold at the time topped within $6 of my target. I think it topped at 1921 when we were calling for 1915 or 1916, $5 or $6. And as we now know, gold dropped all the way down to 1050, which it bottomed at 4 years later. So, when we utilize the principles that Elliott gives us, he really gives us some incredible targeting material. So, whereas you may think my target for this is extraordinarily outlandish, and I'll be honest with you, I do too. But I've learned in all the years I've been doing this not to discount what these parameters tell us. So, let's go into a little more detail and see, where do I think we are? Have we finally topped in this fifth wave? Are we going to have another push higher before this fifth wave completes? Have we begun this long-term bear market already? And that's really the question that the market is going to tell us over the next couple of months, believe it. So let me take a look into my daily chart. Okay. Now, in my daily chart, I have a potential top already in place, but I'm genuinely not sure yet as to whether or not that is the case. And now, one of the things that I mentioned before was that a C wave is a crash wave. Now, even though corrective waves take shape as I said, ABC structures, the C wave crash wave is usually interesting in that it itself takes shape as a five-wave structure. Now, if you remember, if we're talking about five-wave structures, that means I need to see a five-wave move down for wave one of that C wave, followed by a corrective retrace, three-wave retrace for a wave two, and that'll set up your crash for this C wave of the larger degree A wave, which then tells us we have absolutely top in this very long-term bear market. So what I'm looking for over the coming months is I'm looking for how the market will now decline over the coming months. If the market declines in a clear five-wave structure, then I'm going to be preparing for a crash later this year, potentially starting later this year. And that will then confirm that the long-term bear market has begun. Now, mind you, it doesn't, I'm going to say this again, it does not mean that we are going to just crash all the way down to my 1,000 target. Let me show you again. It just tells me I'm looking for a crash in this A wave, just to finish off the C wave of this A wave. Thereafter, we're going to likely have a multi-year, quote unquote, bull market, but that will likely only provide us with a corrective rally, setting up the next crash to lower, and then we'll repeat that again. That is generally the process that we are looking for, which is pretty similar to what we experienced here. And again, remember, I'm going to say, I didn't say this before, but the second and fourth waves, why I call these structures variably self-similar, is that the second and fourth waves are extraordinarily variable in of themselves, whereas a five-wave structure in general is relatively easy to track. Second and fourth waves, and especially fourth waves, are much more difficult and complex and variable. So what I'm providing to you here is just a basic framework of my expectation, but I'm sure that it's going to have a certain amount of variability for which I cannot foresee at this time. And that's where, the continued analysis will come in as we go along. So that's the daily picture. So of course, that's the A wave I'm looking for, and then I'm looking for that bigger B wave rally thereafter, which will set up the next C wave crash. Now, however, alternatively, should the market only pull back in a corrective three-wave structure that does not substantiate that we are moving down in a five-wave structure, and we do that utilizing our Fibonacci pinball methodology to determine whether it's corrective or not. But should the market provide us with a corrective pullback, then that's going to tell me, okay, it's time. Now, I've already taken a significant amount of cash out of the market based upon this. So it will tell me if we get a corrective pullback, I will be putting that money back into the market, because it tells me we will likely have one more rally into the end of the year before this long-term bull market completes. So that is my general view of the S&P 500 as we go out into the end of this year. Let me show you how I am viewing gold. Now, I will tell you this. Back in 2011, I told all my clients, now is a good time to start selling out on your gold positions as we approach that 1916 region. In December of 2015, I did the exact opposite. I put out a note to them that now is the time you want to start layering back into the market, because my belief is we are about to begin the next phase of the bull market. Now, where we stand today is we are approaching the completion of that bull market phase, which began in 2000 and the end of 2015 into early 2016. So my expectation is, as you can see from this chart, I am expecting a larger degree pullback still to be taking shape over the coming month or two. I don't know how long it'll take, really. but I'm still expecting at least one more bigger pullback and then one final rally before this long-term bull market in the gold market completes as well. One of the reasons that I don't believe that the gold market has indeed topped, even though, yes, I have that as an alternative path, and I don't have anything that's telling me that that is the case yet. But the one thing that is telling me that it hasn't likely topped is that silver has not seen its catch-up move that traditionally we see from silver. So until I see a parabolic rally in silver, which may have already begun, it seems, but we're still waiting a little more confirmation of it. But once we see that move in silver, then I'll know, yeah, we are approaching likely the end of this bull market in gold, the segment of the bull market in gold, which started end of 2015, early 2016. The same thing with the various mining stocks as well. So while I still think there is some higher potential in the market, I am not of the opinion of that most are that we are just starting this most major of gold rallies. You know, most people will tell you that as the market is completing its structure. If you remember back in 2011, for those that were trading gold at the time, the only thing you were hearing from analysts was the only argument you would hear was how far past 2000 is gold going to go. It's the only argument you would hear. I mean, there was almost nobody talking about a top in gold. Well, I think we're going to be seeing the same thing here. Everybody is getting so bulled up on gold. Everybody believes that we're now going to 5,000 gold. I've heard 7,000 gold. I've heard 10,000 gold. We're now starting. I think we're coming to the end of the cycle that we began back in end of 2015, 2016. And I'm looking for at least a 5 to 8 year correction in gold. And I think it could take gold back to down around 1,300, 1,500, somewhere around there. So I'm not expecting that gold is going to go into a massive, massive move. I think the last move higher will feel like it. But my expectation is, I think we have one more rally to be seen in gold. And then I think we're probably going to be seeing a very long-term correction in gold. 5 to 8 years would be my guesstimate at this point in time. I wanted to take a moment and also just show you the USO chart on the daily, because I think we're seeing a very interesting segment in the USO as well. And this is more on the shorter time frame. I've had that target box up there for quite some time. And if you notice, we have gone just side. I mean, that is a lot of sideways in the metal in a market. And if you see, this whole thing here has been a B wave per my view. And remember, within a larger corrective structure, ABC. So I believe we are now finishing off a very large B wave. And if you remember, when a B wave completes, we then see a C wave, which will likely be quote unquote crash-like. I can't tell you what could cause it, what's going to cause it. I'm an analyst, I am not a prophet. But what I can tell you is that should I see an initial 5-wave decline, as we're now moving into our target box, should I see an initial 5-wave decline from this point forth, then I will be looking for a crash potentially to begin in the oil market for what I'm looking at as a C wave, which will probably take us in the USO back down into the 50s would be my expectation. Okay, so I mean, at this point, I think I can complete my overall review. I think it took me a little longer than I expected, but I'd like to open the floor to questions, and please let's try and stay on topic. Okay, thank you.
Avi, are you ready for questions? I apologize.
I am ready for questions.
All right, let me see what I got here. question here. I find that the weekly charts are more reliable for analysis than daily charts. Do you find that also?
Not really. Remember, we're dealing with fractals, and it means that, if a fractals work on all different time frames. So it may be that you're just more comfortable in trading or investing based upon longer time frames. But I can't say that the daily is less reliable than a monthly or so on and so forth. I don't think I can say that.
Another question. What is your shorter term target price for gold pullback and gold then rally before down to 1,300 gold?
I'm not going to go through the micro. I'm not really going to go through micro, but what I'll show you is this. I mean, this is a chart I have on GLD. And this is what you could probably look to as a reasonable guideline. I'd like to see GLD get back down to at least around the 275 region for that fourth wave. And once we get to that point, I probably will try another long trade for one more high and for one more rally. And that last rally probably will be parabolic in nature. So no, I'm not expecting that gold's going to get to 4,000. It could, conceivably it could, but right now it's not my expectation. I'm going to need to see how waves 1 and 2 set up so we can start projecting where our expectations will lie, where gold will probably head higher to.
All right, another question. What do you consider top in the gold and silver markets?
I think I probably just answered that.
Yeah.
I don't think we're going to get to 4,000. It's possible. I'm going to have to wait to see how that last fifth wave rally takes shape before I'm willing to lock in a target.
Will the market be up or down from today's closing prices in October?
If you tell me, if the person who asked that question can tell me, and I'll show him my question very specifically. Oops, wrong one. If you can tell me whether this next decline will be a 5-wave decline or a corrective 3-wave decline, then I'll tell you where I think the market will be in October. In other words, I need to wait and see what the market tells me over the coming months in order for me to know, have we finally topped or do we get one more final rally? So I can't give you an answer to that yet. As I say before, I'm not a prophet. I'm an analyst. There's only so much I can foresee, and I take my cues based upon the structure of the market. The structure of the market tells me about where mass sentiment is. And when I know where mass sentiment is, that can tell me what I'm looking for. For example, at the end of 2019 into early 2020, mass sentiment was extreme on the long side. So I was looking for a large degree decline. I didn't expect it was going to happen within a 3-week period, but I was looking for a drop back down to the 2,200 region on the S&P 500. In other words, I was looking for a 35% decline. Once I got that first initial move down, then I said, oh, we got it. It's getting set. We're about to see a sizable decline. And that's what we got in February and March. February set it up. March gave it to us. So that's what I'm waiting for here. I'm waiting to see how the market declines next. It could still try to push higher one more time towards the all-time highs, but the key is, how does the market decline next? And that's going to tell us how we approach the rest of the year and potentially even far beyond.
Thank you. Can you repeat your SPX forecast for the remainder of 2025? What level do you think we top out at for the long-term wave?
I'm probably repeating myself again. There is potential we have already topped. If the market drops in a 5-wave decline from here, then the market has topped. And now I don't believe we'll see further highs or appreciable highs for a very long time going forward. If the market provides us a corrective pullback, I mean, minimally, I would probably expect that 6,600 region to come into play. And I would say probably that would probably be my minimum target, but we'll have to see how that develops. What's going to tell us, remember, C waves. Well, you know what, that's going to get into too complex of a discussion. I'm going to leave it at that. I don't want to get into too complex a discussion of the Elliott wave analysis, as I'll lose a lot of people because there's a lot of difficulty in this final rally that we've been dealing with.
If you're looking at gold topping soon, would you be expecting the USD to climb? If yes, what level?
Okay, that is an excellent question. I didn't say gold is going to be topping soon. I don't know how long that final rally can take. It could take us well into 2026. It all depends on how fast it completes its next five-wave structure. So I can't tell you soon. I can't tell you a year from now. I can give you a guesstimate, but my expectation is it should take us at least into the end of this year, maybe potentially well into 2026. But oddly enough, now I don't believe in correlations, because what a correlation really is that two charts trading in certain relationships for a period of time, and then that correlation breaks. You know, correlations, when you understand it from an Elliottician standpoint, you recognize markets each trade within their own patterns. So if you look throughout history, you know, a lot of people say, well, gold is the place to hide when the equity market has a problem. Well, that's not true when you look at history. When you look at history, you'll see that there are times where gold has rallied with the market. There's time where gold has gone against the market, and there are times where they both declined together. For example, in 2008, gold lost over 30% of its value during the stock market, the overall stock market crash. Most people don't either remember that or care to remember that, because it really dissipates the entire gold as a safe haven premise. And most people are not comfortable with that. Most people believe gold is where you're going to go for a safe haven. Unfortunately, it's not the truth based on history. So I stay away from correlations. That being said, I am tracking in the US dollar the potential that we are going to be seeing a major bottoming develop very soon. And once that bottoming completes, there is potential for a decade-long rally to be seen in the dollar. I don't have that confirmed yet. I need to see how the dollar begins to rally off of this low that I'm expecting in the not too distant future. But if that rally begins a five-wave structure, well, ladies and gentlemen, that tells me that the dollar potentially has another maybe 8 to 11, 13-year period where I think it can rally. So it could take us well into the 2030s for another major rally.
All right, let's see if we've got any others here. I apologize if you answered this one. If the SPX appears to be reaching extremes, would this be a good time to nibble short?
So the answer is, I don't like, until the market has given me confirmation that we have turned from a long-term bull market into a bear market, I still would rather apply bull market procedures to it. In a bull market procedure, it is not wise to advise to try to time a top from a shorting perspective. If you want to be raising cash, I think that is a very reasonable thing to do right now, at least until the market tells us what it's going to do on this next pullback. In fact, I'm heavily in cash right now. So until the market actually tells us, raising cash, I think it's a great idea. Shorting the market, I usually do not advise shorting the market during a bull market unless we see a 1-2 structure develop in a C wave, such as this. So if we see this red 5-wave decline for this wave 1 of this C wave, and then we get a corrective wave 2 rally thereafter, I would consider shorting this for this decline. Other than that, and I would probably do so quite aggressively, because that would give me a strong indication that the market is about to see a sizable decline. And even though until we actually get that decline, we don't confirm that the bear market has indeed begun. I would still consider that to be a great shorting opportunity. Until that time, I've got a short-term, a smaller degree support at 59.20. As long as we hold 59 over 59.20, the market can still push higher. And then you need to take out 57.67 before I can make a determination as to the nature of this pullback. So, how nimble are you? By the way, guys, when I suggest something, it's not to be taken as an absolute. I have about 9,000 clients, close to 9,000 clients on Elliott Wave Trader. And they range in how aggressive they are, what time frames they trade. Nobody is the same. Everybody has different risk profiles. So what one may do, another may not do. And as I get older, my risk profile has significantly changed as well. So there are a lot of things to consider. So if you're going to ask me, should you short now? Most people, the answer is no. The question is, what is your risk profile? How nimble are you? What are your trade parameters? There's so many ways to answer that question. For most people, the answer is no, you should not short now. It doesn't mean it's for all people. If we get below 59.20, then that short may apply for more people. If we get below 57.67, well, then that short may apply for even more people. And if that drop below 57.67 is a five-way structure, then I would probably suggest even more people shorting if that is your nature. There are a lot of people that don't even like to play the short side of the market. So it's a loaded question you're asking me, and I am hoping I'm giving you a completed answer to that.
All right. If you feel gold will not get much above 4,000, what would you expect silver to rally to?
I think silver will go north of 45. I have potentially as high as 60 to 70. A lot is going to depend on how parabolic silver will act during that last rally. So again, until I actually see how that last rally begins to take shape, I cannot come up with a target. But silver, like Bitcoin in a certain way, is quite wild. So I cannot come up with an absolute target. I would safely say silver should go north of 48. 45. Safely, I could say it should go north of 45. But yes, it could go up to the 67 range.
67% of the days going back to 2004, gold and dollar moved oppositely. Can this be used for gold charting?
No. It goes back to my discussion of correlations, ladies and gentlemen. Stay away from correlations, unless you know when those correlations are going to end. And if you're following correlations based on the pure correlation, you won't. I remember back in 2015, I saw in a number of charts, a lot of the correlations that most people were following were about to break down. Why? Because I saw changes of direction in some of the underlying Elliott wave charts that were seemingly correlated before. So I wrote an article at the time and I said, I'm seeing a lot of followed correlations that are about to break down. Maybe about 3 or 4 months later, I think it was Morgan Stanley came out with a big article that said, we have never seen so many correlations break for quite some time. Clearly, all those correlations began to break down. And we can foresee that if you understand where we are in each individual chart. So I would not follow a correlation unless you understand when that correlation is going to break. And the only way you can really understand when that correlation is going to break ahead of time is based upon the individual charts and when each chart is completing its direct structure. Then if you're going to see a change of direction in that one chart, will that same change of direction apply in the other chart so that it may stay correlated or not? If it doesn't, you're going to break the correlation. So that's why understanding how to chart each chart on its own is of ultimate importance. And I am not one that really takes two correlations. You don't need correlations when you're able to do this.
Are you expecting the gold fourth wave decline to be a quick vertical down move?
Vertical down, well, I'm looking for a potential C wave down. So the answer is I am looking for a sharp decline, yes, but I'm waiting for the 1-2 to develop to give me that that sharp decline. Yes, I'm looking for a sizable and sharp decline.
Just looking to see. Do you have a scan of stocks currently on the beginning of wave 3?
The beginning, very few stocks throughout the entire market are at any beginning of a third wave of any, of a major degree. And that kind of is supporting our premise for this very long-term bull market to be approaching completion.
I don't have any other questions.
Okay.
Any other questions out there? If you want to post them in the chat. Oh, I know this one's about platinum, so I know you were talking about gold and silver, but
Yeah, I'm not the one that tracks platinum, so I cannot opine as to platinum. I apologize.
I have another one, but gold is denominated in dollars. Does that change your view of correlations between the two?
No. There are times where we have seen 10% plus movements in both gold and the dollar in the same direction. Sometimes it's even up, sometimes it's even down. The answer is no to your question.
A question on Bitcoin.
Yeah, let's pass on Bitcoin.
Yeah. Another question on platform. I know we're not going into that. Any other questions out there?
Now, I will tell you, I will add a final point to the end of this. And back in 2016, I also believe I wrote a very long-term article publicly. And of course, I showed it to my own clients first before I put it out publicly. And it was saying, look, in 2016, I'm starting to see storm clouds that are going to build. I don't believe we're going to see them fully formed until probably the mid-2020s. But by that time, you really have to have been preparing for what I believe will be a major storm. Now, this was clearly, it's almost 10 years ago that I wrote this, and now we're approaching that point in time. So at the time, my clients asked me, well, how should we prepare? My answer was basically, well, raise a lot of cash and put that cash in safe banks. Well, of course, the question then said, well, how do we know what a safe bank is? So one of the things that, we started looking at, I started looking at this about 3 or 4 years ago as to what is a safe bank. And so I started looking at, for those of you that may know my background or may not know my background, I started from the fundamental side of the market. I was an economics major, an accounting major, a CPA, tax attorney, and LLM in tax. I put together a lot of large deals, being a national director and partner at a major firm for many years. I know how to take apart a balance sheet. So I looked at the Elliott wave charts of the banks, and a number of them started looking really ugly to me. So I started taking apart the balance sheets, and the balance sheets looked even uglier than the Elliott wave charts from a long-term perspective. So I hired a banking analyst, and the two of us started poring over. Now there's about 4,700 or so banks in the US alone. So we started poring over, banks, banking balance sheets to see, can we find any balance sheets that look healthy enough that we would want to have our money housed in those banks. And I will tell you, it took us the better part of about 18 months just to come up, maybe even as long as 2 years. I don't recall exactly. It took us at least 18 months just to come up with the top 15 banks in the United States. The reason is, for example, back in 2007, there was one issue on bank balance sheets that took the banking system down in 2008-9. Today, even though everybody is so sure the banking system has been fixed, today we have 5 issues sitting on bank balance sheets that could take the banking system down. And when one goes, they will probably pop all the others. And that's the problem I'm seeing. When we look at the bank balance sheets from a solid perspective, we have to look at, do any of these banks have any of these 5 red flags on their balance sheets? If they do, we just move to the next balance sheet. And a significant number of banks in this country have at least one of those issues on the bank balance sheets. Now, I wrote an article not too long that I think said about 1,780 or so banks across the country have a major issue with commercial real estate. So much so, they're about to see a refinancing wall coming up starting at the end of 2025, early 2026, that then tails all the way out into 2027. That means that period of time is going to be a time where those 1,788 banks are going to be very high risk banks. And that's about a third, a little less than a third of that's more than a third of the overall banking sector. Now, for those that know your history, and I strongly suggest everybody learn financial history, because they say, the history may not necessarily repeat, but it certainly rhymes. And as George Santayana says, if you don't understand history, you're bound to repeat it. Both those statements are very true. So I strongly urge everybody, learn your market history. And one of the best times of learning history, if we're going to go into a major bear market, is learn the history of the Great Depression. What happened during the Great Depression? What happened after the 29 market crash? Yes, it's going to be different today, but it's not going to be that much different. If you remember, during the period of the Great Depression, I believe it was close to 50% of the banks in this country went out of business. But it also means that 50% of the banks in the country made it through the Great Depression. Unfortunately, those that had money in the 50% that went out of business lost a lot of their money. Now, a lot of people today believe and are so fully behind the FDIC and the SPIC. Unfortunately, when you look at the availability of funds for those entities, if you're foolish enough to maintain reliance on that, then you will lose your money. There's no way the FDIC can backstop the amount of banks that could be affected if we're going to go into this major bear market that I expect. And it will be a prolonged bear market. Whereas the bear market that we had, the financial crisis in 2008, was a relatively short bear market. I mean, that crash alone only took about a year and a half. When you consider that, and you consider the potential that I may be looking at as long as a 13 to 21 year bear market overall, you're probably looking at a much more difficult banking environment. So I would strongly urge you to be taking apart. You can go, we have a website called, I guess my concussion is starting to get it to me, saferbankingresearch.com. We have a lot of public articles. We have our due diligence procedures that we go through when we look at banks. I will strongly urge you to read our public articles and to look at the balance sheet of your bank to determine if your bank has any of these 5 major issues. And if it does, I would strongly urge you to be seeking safer shelter. So I'm just going to end on that piece. Are there any other questions before we complete?
Oh, I have quite a few now.
Oh boy, I think I opened up a can of worms.
Gold 270 is equal to what in spot or physical gold?
Oh, I don't know. You'll have to do the conversion.
Okay. Sounds like gold and the stock market will be moving together in this long decline. Can you recommend somewhere to hide?
The answer is they may be moving together, and there may be points in time where they will diverge. So the answer is I cannot tell you. It's all based upon their own wave structure. There is one segment of the market that I am tracking right now that has potential to outperform the S&P over the coming years, and that's actually the emerging markets. But I'm tracking that just to make sure, because right now it's a theory. And I want to see how the next pullback develops in emerging markets, and I may be going heavy in emerging markets after the next pullback.
Which of your calls are you more confident in? SPX, gold, others?
Yes, all the above.
Do you have a time on when you expect the correction in gold?
I will tell you that I've been doing this for a very long time, decades, many decades on my own. And I've been doing it publicly for now a decade and a half, almost publicly, for almost 9,000 clients. 1,000 of them are money managers. So we have a very, very large and diverse client base. I've been doing this for a long time. While we are really good at identifying turning points in the market, I have struggled, and I have done research and research and research over decades trying to come up with a timing component that would even turbocharge our current analysis. And after all those years of searching, I have yet to find anything that can exceed 50%. So unfortunately, I cannot put a timing component on it other than a general guesstimate. So my apologies for that.
Do we need a catalyst to start heading down on SPX, as so far even a war does not move it much?
The answer is yes, a catalyst could be what takes us down, but I will warn you, you don't need catalysts. There have been many market crashes in history that did not have a catalyst. I'll give you an example. 1987. Today, they still debate what the cause of that crash is. The 2010, 2011 flash crash, it was May of 2011, I think. 2010, 2011, I don't remember which one, it was May. That flash crash, no one has come up with a reason for it. There have been many movements in the market that we don't have reasons for. Yes, there could be a catalyst. I'll give you another example. Back at the end of 2019, 2020, I was saying I'm seeing a 30 to 35% decline in the market. So before anybody even heard the word COVID, I started talking about this in November and December of 2019, before anybody even heard the word COVID. I don't know what's going to cause a move, and it may not even be something we can point to. So that's why I say I'm an analyst. I'm not a prophet. We could get a catalyst. We don't need one. All I need to see is an initial break of support, and then I'll know we've begun that.
So overall, buy and hold is no longer a viable investment strategy?
That is my opinion. I can always be wrong. You know, I got to tell you, have you ever heard of an analyst that will put out an analysis and say, this is what I believe is going to happen. I see this, it's a high probability, but I am praying every day that I'm wrong. I'm probably the only analyst you'll come across that says that. Why? Because if I'm right, the ramifications to society as a whole can be quite dire. And that's what scares the living crap out of me, excuse my French. If I'm right, I'm scared to be right. So, you know, I could always be wrong, but I will tell you, I am looking for reasons and ways in which I can be wrong, and I'm not coming up with it yet. And I will be the first to admit and identify where I'm wrong and be able to move into the correct side of the market. When we're wrong, we don't stay wrong long. We like to be on the correct side of the market all the time. And as I always say to my clients, your money is worth a lot more than my ego. So I need to know where I'm wrong, and I need to know where I'm wrong pretty quickly. I'm always looking for where I'm wrong. I have not found it yet. I pray that I find it before we get full confirmation that the bear market has begun. But right now, I'm not seeing it.
Also for USDs to start heading down, does it mean that the economy must be doing well at a
Wait,
low?
does
Oh,
for the
sorry.
what to be headed down?
Sorry, also for USO to start heading down, does it mean that the economy
No.
must be doing well?
No, it does not. Correlations again. USO can lead the economy. Charts often lead the market, often. And I've written articles about that, about why that happens. There's actually a fundamental reason as to why sentiment leads fundamentals. And yes, I'm saying there's a fundamental reason as to why sentiment leads fundamentals.
I've got a couple bank questions. I don't know.
We'll
Does-
try.
Does the safety analysis for banks apply the same to credit unions?
Credit unions, we do not have enough public information to make any reasonable assessments. So if I cannot pick apart a balance sheet, I cannot make an assessment.
If one only keeps a month or two of expenses in a bank, is it important that it be strong, given they would be well below insurance limits?
Again, I don't trust the FDIC, but if you have funds to you available somewhere else that you're confident in, yeah, I'm going to be keeping a few months of expenses in some of the larger banks that I deal with, just for ease of movement. But most of my money will not be in those larger banks. The significant majority, I would say less than 2% of my entire cash will be in those big banks.
All right, I think we've gotten to most of the questions. I know we're about out of time. Any last minute questions? Post them. I know, Avi, we appreciate you taking this session after your concussion over the weekend. So I do appreciate that.
My pleasure, my pleasure. And I hope people have at least gained a little further insight into the markets from it. And I still pray that I'm wrong, but I can't be blind. I pray that I'm wrong, but I have to look at it objectively.
All right, thank you again. And I want to thank everyone that's joined. And we do have another session coming up here at 3:55 if you want to join that one. But Avi, Mr. Gilbert, we do appreciate you joining, and please take care of yourself.
Thank you very much and have a good evening, everybody.
You too. Thank you.